Will the operating system be resilient and revert to what we've known, or could the shock leave a legacy by changing how the system works? Knowing that complacency can be costly, leaders often feel pressured to take action of some kind. But often a shock harbors at once the possibility of true crisis and false alarm. Consider this string of false alarms during just the past 4 years. In 2020, when the COVID-19 pandemic caused extreme uncertainty, a narrative of a new Great Depression took hold. Invoking the 1930s, the narrative predicted an economic collapse worse than the global financial crisis of 2008, a deep, multi-year recession, complete with a U.S. sovereign debt crisis, and later, a dollar collapse. Yet the fearsome intensity of the COVID shock said little about the damage it would do structurally, or about the ability and willingness of policymakers to lean against it. By the first quarter of 2021, economic output had bounced back to its pre-COVID level. By late 2021, the U.S. economy was nearly back to its pre-pandemic trend. And by early 2023, real, that is, inflation-adjusted, output stood 5% higher than its pre-pandemic peak, accounting for more than an extra $1 trillion in output. In 2021, after the vigorous recovery had caught many doomsayers off guard, the popular narrative veered in the opposite direction. Hubris and doom are close cousins, so a narrative of repeating the Roaring '20s suddenly emerged. Now, the digital enablers of the lockdown economy, think Zoom and Teledoc, were expected to deliver a tremendous boost to productivity, to the tune of 100 basis points or more. The pandemic was to be the catalyst that finally delivered tech's long-elusive growth impact. Yet, little of that transpired, and investors who bought into boom valuations of the pandemic enablers were left nursing losses. In 2021 and 2022, when post-pandemic inflation peaked higher and later than many expected, the false alarm of a structural break in the inflation regime sounded. Predicting a permanent shift to much higher and more volatile inflation, the narrative equated post-pandemic inflation to that of the 1970s, an ugly period when inflation expectations were unmoored and inflicted structural damage on the economy. Though inflation will very plausibly exhibit upside risks in the future, the post-pandemic price spike did not signal a structural shift in expectations. Rather, it reflected a cyclical and idiosyncratic mismatch of supply and demand that gave firms a window of pricing power. Collectively, that made for an inflation spike, not a structural inflection. Sure enough, U.S. inflation subsequently declined by 6 percentage points in less than a year, putting to rest the idea of a runaway 1970s-style problem. In 2022, as the Federal Reserve raised interest rates at the fastest pace in decades to fight inflation, the false alarm of emerging market, EM, crisis, and contagion took hold. Popular predictions were that higher U.S. rates and a strong dollar would put EM currencies under pressure and make EM debt repayment harder, thereby triggering defaults and capital flight. But many EMs have successfully weaned themselves off dollar-denominated debt. Their economic management has improved, as seen by the decision of some EM central banks to raise interest rates ahead of the United States. And many simply did not face the same challenges as rich Western economies. As a result, even as the top of the U.S. rate cycle came into view, there was no evidence of systemic EM crises. Starting in early 2022 and into 2023, a narrative of imminent and inevitable rich country recession took hold. Prominent leaders spoke of an economic hurricane, and forecasters' models showed sharply higher recession odds. Fast rising interest rates had derailed the equity market and were seen as doing the same to the economy. Pundits claimed that inflation could not moderate without much higher unemployment, the key determinant of a recession. And though the idea that there will be a next recession is always true, the fact remains that toward the end of